Wow, welcome everyone to our second Conversations at Colony. It's so great to see you all here, and welcome our wonderful panelists. It's so exciting that we've kept the bar high again, like such amazing guests. So thank you so much. We'll have a chill conversation about their backgrounds, about DeFi, and then we'll open it up for questions. I want to start off by thanking our sponsor, Fragment, a new up-and-coming VC in DeFi. I want to, of course, thank you all for coming. And most of all, again, our panelist, Laura Shin. She's the author of The Cryptopians, amazing book. I recommend you all read it. She's also the host of the very famous Unchained Podcast. And Tarun Chitra, the founder and CEO of Gauntlet, and also partner at Robot Ventures. So thank you so much. Welcome. Okay, so to kick this off, I'd love to just get to know you guys better, talk more about your backgrounds. Laura, if you want to start with just talking about what led you to start Unchained and then write The Cryptopians.
Sure. So I actually got into crypto. It'll be 7 years ago in 2 weeks. And I had been covering personal finance for a little while, and I was getting a little bit bored. And my editors at Forbes said, hey, we have an idea to do a Forbes FinTech 50 list. Do you want to head that up with another reporter? So she and I divided the list into subcategories, and I took the category of digital currency and just became completely obsessed. And I ended up writing this really big magazine feature on Chain. I don't know if any of you remember Chain, but that was this enterprise blockchain company, because this was the era of blockchain, not Bitcoin. So my first article about the way things would go in the space was completely wrong. And also for the 2015 Forbes FinTech 50 list, I did not put Coinbase on the list, another big mistake. But anyway, so yeah, a year later, I just was getting super into crypto, and I found out that Forbes had launched a bunch of podcasts. And so I said to my editor, hey, I want to launch one. And so my podcast became the 13th Forbes podcast. And I think it's the only one that's still going to this day. And they dropped it after one season. So I basically found a sponsor. And because it was late 2016, this was not a time when people were just throwing money around in crypto. So I was begging practically these different sponsors. And then finally there was a web design company where they had done some websites for different crypto companies. And so they were oh, we'll sponsor it. I gave them the sponsorship for the full year of 2017. And of course, the downloads just went through the roof that year. And by that time, so initially I was freelance at Forbes, but then in the middle of 2017, I went full-time with them. And someone who was helping me with the podcast said to me in I think it was early 2018, she was hey, Laura, I've been doing a bunch of research on the podcast, and all the other crypto podcasts are charging this amount in ads, and you have way more downloads than anybody else. So you could be making this amount of money. And I was oh, I had no idea. And it was more money than I was making in my job. So I asked, I told Forbes I was going to leave, and what I did was I did 2 podcasts a week, and then that was maybe let's say, 40% of my time. And then I used the remainder of the time to work on my book, which finally came out 2 months ago-ish. And my conception for the book was to describe how the 2017 ICO craze happened. And the funny thing is that the initial idea was an even bigger book than it became, because already it's huge. It's 400 pages, but the original idea was to explain all this money was coming into the system, and so there's going to be some bits on Coinbase. But when I went to write it, I was oh my God, I have way too much information. So I had to just drop the whole Coinbase thing. So then I only ended up focusing on Ethereum, because obviously that was the really new development. So so in the end, the book is mostly a history of Ethereum, and then at the end it kind of goes into the ICO craze. But yeah, that's kind of the general history of my time in crypto.
I love it. Tarun, how about you?
Yeah, so I guess I was born initially crypto skeptic in 2011. but I was working on building sort of ASICs for kind of a weird, which is like custom hardware for kind of very non-crypto use case in physics. And we'd put out this like $25 million chip order, and then our supplier ghosted us for 6 months, and then came back and was like, yeah, we'll give you a 10% discount. We're like, well, you took $25 million. Like, well, what's the deal? And that was when I was like, oh, wow, okay. Something's up. And then eventually they told us, they're like, oh, like, yeah, this like Bitcoin thing, like there's some guy who wants to make some hardware and he's willing to pay us like $100 million upfront cash. And we were like, in 2011, this was a crazy concept. In 2011, FPGA, which is another form of hardware mining, was like barely taking off. I think like there was this huge place in Georgia. If you look at the Princeton Bitcoin textbook, they actually have a picture of like one of the first FPGA farms in Tbilisi. But that led me to just go mine a bunch of Bitcoin and then sell it at the bottom in 2013.
Oh no. Wait, so you went to mine Bitcoin yourself? Like
yeah. This was the era of like you could just buy a couple GPUs, leave it at home. You might get 100 Bitcoin a year. Obviously, remember, the prices of Bitcoin then were a lot lower. So you were like, it's only $1,000 a year, but I'm spending like 500 or 900 in electricity. Like, is it worth it? Again, hindsight is 2020.
Yeah.
And then I think as the academic kind of work in 2015, 2016, like pre-Ethereum, there was actually a ton of research work that kind of started making a lot of the complaints that say like theoretical computer scientists had about how sort of cryptocurrencies worked evaporate. And that sort of got me hooked. And, long story short, I was working in high frequency trading then, and then I quit to kind of understand a lot more about like the security models of these things and really focus on sort of like the economic security of some of these new systems, like proof of stake systems at the time. And that sort of led me down the rabbit hole. And I spent a lot of time writing a lot of the early research papers on sort of why certain DeFi protocols work and don't work, and like how you can test whether they're safe or not, or like how they should be parameterized. So very, very, that's sort of the long-winded answer.
Okay, so you started looking, because you were working at a high frequency trading firm, like at TradFi.
TradFi.
D-Shaw, right? Or
I was at D-Shaw, and then there was another.
Okay.
Yeah.
Okay. And so you started exploring how that applies to crypto.
I started thinking about like the following, which is in proof of work, part of the reason it's hard to manipulate is you can't really control the electricity market globally across the world and like corner that market and sort of like corner the hash power market. Like people had tried, and it like with hash power renting and stuff in 2014, 2015, and it was never really successful at taking down Bitcoin. So it's clear that like at some scale, you really can't corner a proof of work chain. But proof of stake chains, I feel like, especially when people were this is before the ICO boom, but this is sort of the thing that I would say precipitated the ICO boom, where like the Gnosis paper, the Algorand paper, some of the ETH2 papers, they didn't provide the same guarantee. Like you could corner the market for liquidity and lending of the actual underlying asset and affect the security. And so that was sort of what nerd sniped me into being like, hey, these two things are really different. Like everyone's treating them the same, and like valuations are the same, but like somehow if you think about trading against them, you should trade against them very differently. And that means their security property should be different. So that sort of
trading against them is like, you mean buying and selling the tokens like built issued by those networks?
Yeah, so I think the simplest example of this is like, suppose I have a proof of stake network. Why do you stake? Well, you're staking because A, you are long the asset, so you want to own more of it. And B, you want the interest paid from staking yield, right? But the problem is if there's a competitive yield, say like a lending protocol or a lender who says, hey, actually, I'm willing to pay you 2 times what the staking rate is. If you're rational, you will take your staked asset and lend it out. Like, why would you not? But that's sort of a weird form of someone doing a subsidized attack. They're effectively saying like, hey, I'm willing to borrow the asset from you. In proof of work, the problem is to create more Bitcoin, you don't borrow Bitcoin, you borrow electricity or hash power.
I see, yeah.
And that's a different asset. Like they're correlated, but they're actually not totally fungible with each other. Whereas in proof of stake, they are. And so if you start thinking about like, how would you design attacks to like aggregate enough stake to do an attack? Well, you start thinking about like, I try to make a derivative or lending market that can, at least in a short term, provide more returns than the asset itself. And in DeFi, we actually saw that happen later in DeFi Summer, where like all these vampire attacks were effectively, hey, I provided you more yield for a short amount of time, like move your liquidity to my protocol.
Exactly, yeah. Okay, so that inspired you to then go and start Gauntlet.
Yes, in 2018, September 2018.
And can you go more into what Gauntlet does?
Yeah, for sure. So what we do is we monitor DeFi protocols, so like monitor different types of users interacting with them, and then run these simulations of like what happens if like different types of user compositions interact with each other under certain parameters. So like given a certain interest rate curve and certain types of borrowers and lenders, what's the expected amount of default you should get, and like what's the expected loss the protocol takes. And then from that, make predictions and recommendations for, hey, actually this protocol, we submit governance proposals sort of automatically when we see something happen that says, hey, actually the margin requirement is too low. Like there's a lot of risky borrowers. We should like increase the amount of collateral they should put up. And so it's about sort of monitoring and like updating these protocols, but using this sort of simulation tools from trading to influence those decisions.
That sounds super complicated.
Can I also ask a question?
Yeah.
Sorry, as the other journalist, I'm a little bit like, wait, I have a question.
Yeah, go ahead.
But then, so when you're doing that, like, I assume, so you're probably just like putting in a bunch of different assumptions, but then once they kind of launch, then are you feeding that back in so that way then the assumptions change for the next time? Oh, wow, that's
So
cool.
it's like monitoring continuously. So like
cool.
every basically 10 minutes, we look at the like last 10 minutes of new activity. We look at the existing models that we have of users, and we look at the last 10 minutes. We say, how much do they overlap? If they don't overlap, try to fit some new user who matches what's happened in the last 10 minutes. Rerun this thing, see if, So it went from being like static to continuous. I think that's how.
Yeah, so it's basically like continually getting smarter.
Yeah.
Which is super cool. That's interesting. So it's almost like an AI, almost.
Sort of, yeah. But there's still a lot of like one problem with like purely black box AI models. And maybe this is why I kind of rail against large language models on Twitter from like a epistemology standpoint, is that you need some notion of interpretability for governance in crypto to work. Like if I just tell you like random black box model that you have no intuition for like what the sort of inputs are, says like, hey, change this parameter to this, like people in governance are going to be like, well, why do I vote on that? Like, and so you do need it. There's this trade-off between like model precision and interpretability that you need kind of in these kind of financial scenarios.
So how do you make money from that? Is that like you're trading for for Gauntlet itself, or it's like other protocols use this this service?
DAOs pay us
Right.
for doing this monitoring and submitting proposals and sort of like kind of basically like acting as a service. So it's like DAOs pay for it like they pay for software as a service.
Got it. Is it similar to like in traditional finance, like algorithmic trading? I mean, is that kind of the like you're like deploying bots to do this for you and just like take advantage of these like imbalances in?
So we're doing the opposite, right? We're saying like, hey, here are the bots that exist, and given what's happening right now, and given the parameters that the current protocol is set up with, here's what the expected outcomes are, and you should, if you want this type of outcome, maybe like to increase revenue in the protocol, you should change the parameter by this amount. So we're sort of trying to play the opposite. So like if you think about a counterpart like FTX or like a brokerage, they have a risk desk that's like constantly monitoring their users, their parameters, like what's happening in the system, and then they update those sort of in real time. But a DeFi protocol kind of sets it and forgets it, and it can only kind of edit things via governance, right? And so it does need the same kind of service of people like monitoring, and so that's really what.
That's so interesting. It's like you really can't find something really comparable outside of DeFi. Like, it's so specific to this ecosystem.
I think the closest thing you see is actually like tools in online advertising that like monitor, like online ad auctions, and then a lot of this is internalized to Facebook and Google, but like there used to be other companies that they bought stuff from and then they acquired them that monitored like online ad spam, online ad sort of quality, and like whether like people were getting bid sniped of like, people putting up fake bids for certain keywords so that you had to pay more. So in the early days of the online advertising, there used to be this thing where like the two companies are competitive. One would try to hurt their competitor by just like bidding on the keyword of their competitor so that it costs them more to like advertise in the same place. So like, let's say Coke and Pepsi were bidding on the same piece. Let's say it's like on the New York Times front page. Well, Pepsi would buy all the Coke keywords that Coke couldn't advertise under Coke. And so like that type of stuff, like making sure that you don't have too many bad actors who kind of like reduce the quality of the advertising. Like there has been stuff like that. So it is similar. It's like sort of a little bit like that. And also what you do in trading when you monitor your own strategies. So it's like a hybrid of those.
So interesting. Laura, transitioning into kind of the world of media and how you've seen that evolve since you started covering crypto. Like one of the first like mainstream like financial reporters to cover it. How have you seen the space change? And I'd love to hear your thoughts on like Web3 native media. Like how are DAOs and like tokens and just like crypto native tools starting to influence media companies?
Oh my gosh, you asked me the one thing that I've been like meaning to look into and I haven't really. So I don't know if I have a ton of thoughts on that. But basically, so I do have some thoughts on that because I have looked into things like Bitcoin and stuff like that. But I do feel that actually, at least so far, they're better maybe for people that are kind of like starting out. Because I frankly was looking for some of the things that I was interested in doing and I was like, oh, it's not going to work for me for these reasons, whatever. But I do know that, I mean, didn't early on, didn't the Defiant get funding from Gitcoin? I seem to remember that. Yeah. And so you probably did that when you were at like an earlier stage, right?
Yeah.
Exactly. Yeah. So like I noticed a bunch of the projects that they're funding are kind of in that mode. But I know that there are other things too. I just was thinking, again, I think I like checked out Mirror and I was like, oh, this isn't going to work for me so when it comes to like something really investigative, you don't know how long that's going to take, and it just could take a lot of resources. And I'm, not really sure if a community is going to be willing to like pay kind of the amounts of money that would be necessary for that kind of thing. So that's probably just one thought I have. That like I think that model, at least for the ones I've checked out now, as they're currently structured, they probably are better more for people that are kind of like getting their feet wet and launching something. But in general, what I would say about crypto media is that it's definitely kind of become more diverse. You've got like mainstream media outlets that are really kind of filling out their bureaus. Like even a small publication like The Information, I noticed, they actually have really good crypto coverage, even though it's like kind of a newer publication. Because like a number of their reporters have reached out. Like I've talked to like 3 different of their reporters recently, and they all kind of are knowledgeable about crypto. But clearly like we're seeing a lot of coverage from like the Wall Street Journal and the New York Times and whatever, and it's like a diversity of reporters, even like from different desks. It's not just like the tech desk, but it would be like even now culture reporters are doing things on NFTs or whatever. So I think mainstream media is kind of understanding like, oh, this is something that, it's like the internet where, you're going to see it kind of show up in multiple places. And then on top of that, I would say that the crypto native media, I think, is like getting a lot better. I think, there was a time when it sort of felt like it was frankly harder, I think, for crypto native media to attract kind of like quality journalists from outside. And then now, like with people like you and me and, there's just so many reporters that have a really strong journalistic background that are now getting into crypto native media. So I actually feel like kind of at all levels and in all different ways, I'm seeing that, crypto media is actually just improving, definitely like well beyond what it was like in 2015 when I first started.
Yeah, it feels like from both kind of mainstream traditional media, that's getting more knowledgeable about crypto. It's covering crypto in a better way. Like Bloomberg itself now has a dedicated crypto team, which it didn't have back like when I was there. And it looks like more mainstream outlets are having their dedicated crypto teams. And that just like improves coverage so much, because before it used to be like, oh, you're a stock reporter, go cover crypto market. And so you're like, you get those sorts of stories when it's like, oh, the price went up, the price went down. And that's pretty much as far as things went. But now like you have people with like more expertise in the subject, which is great. And I think you're right, like crypto media, like dedicated crypto media is getting so much better. Do you think like in the future, like would these distinctions even make sense? Like if like crypto stops being so niche and it's just like, okay, a part of life. I
do still think we're gonna kind of see more like crypto dedicated publications and then mainstream, just the way that, we have like Wired or like MIT Technology Review or like IEEE News. Like there's like a bunch of ones where it's kind of like focused on tech, and then there's, a lot of the mainstream outlets will have their own tech reporters. So I actually think it'll kind of continue this way. But I do think that the crypto portion of it will just grow bigger and improve.
And then going back to kind of the like Web3 native aspect and how you're seeing kind of tokens get used, it's interesting that to you kind of what's missing is some sort of funding that enables maybe longer term projects. Is that right? Like, is it now, and maybe that's kind of crypto in general, kind of rewards like more short term thinking. And so that is not very conducive to like investigative journalism and kind of these more kind of ambitious kind of research projects.
Yeah, well, I have to say, like one other thought about that is I also think one of the issues with that is that a lot of that is like very community oriented, and then like when the community funds you, like they sort of, I'm not trying to like criticize this model or criticize people for doing this, but like they kind of feel that you owe them something. But like when it's an investigative thing, that can take a very long time. And you may, you don't know what you're gonna come up with at the end, and you don't know how long it's gonna take. And it's sort of like doing a Kickstarter. Like I know a lot of people that do traditional Kickstarters, and then they realize suddenly like there's just people hounding them, and like they get upset when they don't get whatever they wanted like at a certain time. And so that's like another reason that I thought, I don't know if this will work for some of the ideas that I have, because it's like suddenly now you have this like other part of your job that you have to do where you're like accountable to these people that sent you money. So I think that's another thing that I think about. I just sort of think that like for certain types of journalism, like that will work, and then for other kinds of things it won't. Or I don't know if it won't, but at least like the certain models that I've seen that have been set up, they don't really fit.
Yeah, makes sense.
Actually, one thing I might add to that is, so like I'm in a DAO that does sort of art collection called Pleaser DAO, but we, with a couple other DAOs, like started this thing called Free Ross DAO, which was like dedicated to Ross, the sort of founder of Silk Road, and who's in jail, and there's sort of this like kind of libertarian free him movement. And an interesting thing that I discovered related to this from that is like the point of the DAO is actually to make this documentary to try to like help lobby for him to get out. And you can't make a documentary in like a month, right? Obviously it's like a long-term project, and there's within like 3 weeks there already like it was a lot of criticism. And it's like now there's like a lot of like having to constantly post status updates and like proof of documentary recording. And like I feel like that has slowed down their progress on actually making the documentary from watching this as a somewhat interested bystander, quite a bit, quite annoying. Like I could imagine for them as filmmakers, it's like not fun to have to like keep posting status updates and write little like mini investor letter type things.
Exactly.
So
well, actually, so Cami, I have a question for you because I think parts of your model are kind of crowd. Yeah. And so did you find that suddenly that was like an extra part of your job?
Yeah, I mean, I was just gonna say like that, just like, yeah, I can totally relate. It's hard. Like I think, yeah, like crypto is very much geared towards just like the short term and immediate like reward and gratification. And some projects are just not built that way. And yeah, the Infinite Machine definitely not. It's a long-term project. It's like major feature film that takes 2 years to produce. And we are funding it with NFTs. So we do have this community, and I mean, the whole idea from the start was to attract people who are really in it for the long term and who want to be part of this project because they want to fund something that historic. It's like the first major Hollywood film about Ethereum and bringing Ethereum to the mainstream. But of course, like you won't see anything, you know, for a while. But we do get that as well, like in the Discord. It's like, so like, what are the producers up to? Like, why don't we see any updates? And so you have to like, you're forced to like, yeah, give like weekly updates when it's like, okay, like, I don't know, like what, like what can I tell you? You know?
Controversial opinion is a lot of professions should not have to be influencers. Like, you know, like they shouldn't have to be just like making a TikTok about like.
Yeah.
But can I ask you a question about that? So you're funding it with the crowdfunding, or like I don't get how this works. Like, is it partially funded by that, and then the other part, how when you say that like you're funding it, how with the NFTs, like?
Yeah, so we designed an NFT collection linked to the Infinite Machine. It's 10,499 NFTs, and that's linked to EIP 1559, like the block number. And we are selling NFTs, and the funds from those NFT sales will go to fund the movie. So it's like very directly kind of a vehicle to crowdfund the production of the movie. The NFTs themselves are like backstage passes to the movie. So like, I think it's like 60% of NFTs have like these Easter eggs inside of them, which give you like different things like a chance to be an extra in the movie, a chance to like be named in the credits, be invited to the premiere, be invited to a shooting location. Down the line, the idea is that these NFT holders will form part of a DAO, and the DAO will have like an executive producer title in movie production. So it's like if you're an NFT holder, you're actually kind of part of production, like alongside Ridley Scott, who is co-producing the movie. So I think that's pretty cool. So that's kind of the idea behind this. It's like I'm an executive producer in the movie, and well, when we were thinking about, okay, like how to fund this, I said it should really be, it's like the first movie about Ethereum should be funded with Ethereum, with Ethereum community, and that's why we decided to do this NFT project.
Wow.
So IMDb needs NFT verification soon.
Oh yeah. Yeah, we'll see kind of the octagons in. Yeah, but it is. I've seen that it's. I've seen kind of how irrational the NFT market is, like pretty, I don't know, firsthand. Because obviously I'm super biased. Like I love my project, but it's like I'm building something real here, and then I see kind of these like random other projects like really take off, and like, you know, so it's like, why are these like pixelated birds like at 30 ETH floor, you know? Well, my project is like, okay, it's doing well, but it's not 30 ETH floor, you know?
Right.
Anyway, and I'd love kind of your thoughts on this, like on the NFT market, like, what's going on? Like, there's like, is the top here? It seems like there's like still a lot of volume, but everything is being concentrated in just a few projects. Where do you see things going?
Well, it's so funny that you're asking this, because when Tarun was talking about his thing, I was like, oh, well, people aren't rational actors. So how do you kind of account for that in your models? Because I look at the NFT market and I think the same thing. It's a little bit like, people aren't being rational. Not that not that any market is ever rational. But yeah, it's just like so much more obvious somehow when you see, things that are, they're not like great art in my opinion. Not that my opinion, it's not like I'm like some art curator or whatever, but still, and they're just really valued by the market. And yeah, it's like a bit confusing, so.
It is. Yeah, I don't get it.
Yeah, I'm not, I don't understand the NFT market very well. But yeah, to your point, I definitely think it's certainly less rational. I think the weird thing about it is that it's like forced a lot of people who are not traders into being traders, right? Like somehow like that's some part of that market. It's like a fish only market plus like a couple of sharks. Like that's the difference. I feel like DeFi is everyone's a shark, so it's a little bit like fairer. It's like which which is why rationality is you can be closer to rational assumptions. But like NFT market is like very much like there's clearly a lot of fish and clearly a couple of sharks. It's like a really bad online poker room.
And whales.
Yeah, sorry. Well, whales and sharks are colluding. I think like it's really hard to understand why certain collections have just like stuck. I think part of the reason from a Western version of the world we don't understand this is like Bored Apes are actually like really popular in China. And I don't really, it's like a cultural distinction. Like people here make fun of them, like in spite of the fact that, you'll see a lot of them. I feel like it is generally like viewed more negatively, but in Asia, they're like somehow like the most popular kind of thing. And I don't know, it's like at some level, the NFT market is like whales mixed with kids who wait in line at Supreme, and like I don't know what that market is. So it's certainly not rational, and it's certainly like teaching people about buying illiquid assets. Like it's hard to get out of them. But I feel like the concentration effect has actually come from the tooling, like the fact that it's so much easier to sweep for the average person now. And like that a lot of the aggregators across markets have like basically been kind of driving a lot of the volume, and like the primary markets are like less important, has actually been a huge change in the last 3 months. OpenSea buying Gem, Gem, who OpenSea just bought. So it's like Gem, Genie, a lot of the aggregators basically let you buy, list your NFTs on multiple marketplaces. They let you sweep across multiple marketplaces. And so they've made the illiquid parts of the NFT market feel more liquid to participants. And what that's done is it's concentrated most of the trading volume to the things that had higher trading,
right.
And so
it's like a self-fulfilling
thing, and it made it worse for smaller collections because like a lot of the smaller collections are only listed on only certain platforms and like with certain types of liquidity. So I think there's that market structure change that also happened in DeFi, but in DeFi the aggregators don't have that much power like the Matchas and 1inch versus like the primary protocols, right? Like there's a reason Uniswap still dominates a lot liquidity wise, even though there's like so many other AMMs that have better properties, and part of it is that it's just like they have a lot of user flow from their UI. They don't get a lot of users from aggregators. But OpenSea bought Gem, and I think that was almost an existential purchase in some ways because Gem was like really driving a lot of the volume there on chain, and you can see it on chain, and it's very, very clear that like there's some sort of market shift that causes so like microstructure shift.
And it was because of this ability to aggregate multiple purchases in one place
and then sweep across multiple exchanges in a contract that didn't cost you much more gas than a single exchange. So like there was this war to just like, so Genie started it, and then the Genie CTO quit to start Gem. and Gem just like was like all about like minimizing gas fees to do this like multi-platform sweep and aggregation, and then that's why OpenSea had to buy it for like a lot. I was surprised they sold, to be honest. That was a little surprising.
Wait, and was the acquisition amount revealed? I don't know if I...
No, but like, I mean, people had surmised on the internet. And I would say that like the rumors, I checked with people who were investors and they seemed to not say no. So like, you know.
What was the rumor?
Like 300 million.
Okay.
Which is kind of crazy because Gem was started like 4 months ago.
It's insane.
Yeah. So like, I think everyone knew that it was an existential threat because a lot of volume that was going to OpenSea primary was going to LooksRare because the aggregator doesn't care. It's just like giving you best price execution. So I would say maybe not like the whole answer to your question, but I do think that's actually like a pretty large part of the market.
Yeah, no, super interesting. Do you guys hold any NFTs?
Actually, this goes back to the irrational part of the question because I used to really not understand NFTs. And then when Kings of Leon announced their NFTs, I was like, oh, I have to have one. It was just like the first time when something I was interested in real life intersected with crypto, which I'm obsessed with. And I was like, I have to own that. So, I mean, I didn't, obviously I didn't get one of the expensive ones. I just got the album thing. But that was the first moment when I finally understood NFTs. It was just like this emotional response. I just needed to own one. And yes, I could get out my streaming service for free, but no, I wanted to own that NFT. So I'm sorry. Oh, so yes, I own that. I own my like ENS names, Laura Shin, Unchained, whatever, anything associated with my brand. I get so many imposters, it's like ridiculous. I have to do that. And then actually oh my God, this is so funny. We're having this discussion because, so I had to file an extension of my taxes because like just the way my book launch was and then the book tour and everything, I just did not have time to do the taxes bit, but I suddenly remembered, I was like, oh, shoot, because basically one of my sources was like, oh, do you want this NFT? And I was like, oh, sure. Okay, did not think about the fact that this will probably have tax implications for me. And I think he actually was literally doing it to offload his own tax, yeah. And then so after that, I was like, oh no, like I own this weird NFT, like it's not even like pretty or anything. And I think he even gave me a second one. Like all this happened at the end with my book when I was like not paying attention to anything really in my life. And it was, anyway, so it's so funny that you asked me this because literally like a few days ago, I was like, oh, I have to like look up these NFTs that I got to figure out what the tax thing is. But so I own those. I don't think I own anything else.
Were they like famous NFTs?
No, one was for something called Lobster DAO. And then the other one was, that one was like it's like a wild looking variation of CryptoPunks kind of. Yeah, I forget the name of it
like
though.
Thousands of collections like do that.
Yeah.
Okay.
Actually, before how many people in this room filed for an extension? I was just curious. It's like your crypto amount. It's a good time to I own a bunch of things. I won't dox myself. I mainly buy art from my friends who do generative art. I used to do generative art a long time ago. And I'm happy to see them get rich to quit their jobs. So nice. I've helped them do that, I guess. I'm one of the 10,000 plus people or whatever, whatever number of people have done that.
But one thing actually I will add is I really wanted to buy one of the Crypto Coven witches, and I like,
me too.
I was too busy, and then I think after Linda Shea tweeted about them, and they were all gone, and I was like, oh, I should have done it because I saw Amber Balday at some event, and she told me about them, and so I like even had the scoop early, but I was just too busy to actually buy one, so then I missed out.
Yeah.
But oh well.
Same.
Or mint one, I guess, because it was minting at that time.
Yeah. I like minted a World of Women like when they just came out, and I was like, oh, these are cute, like okay, and then like sold them. I was like, oh my god, I'm getting so many bids, and like just like sold it like way at the like near the bottom. So that was one regret. Okay, I hope you both will have Infinite Machine NFTs in your collections soon.
Oh, I will buy one.
Okay, good.
Actually.
Good. Okay, moving to DeFi, what are you guys seeing that's exciting?
Oh, wow.
Or like, what's the most exciting thing happening in DeFi? Could be just like, I don't know, like recent news that have like come out or like a project that you've tried or,
Well, so actually so I have this like premium offering where I just do these videos that I release only to those people, but I just did one on Aztec protocol, which does like privacy for DeFi. And it's like its own layer 2 on Ethereum. And I thought it was pretty interesting. Though maybe these are like questions for you guys, but I was kind of thinking like, so first of all, we've been talking a lot, obviously, about bridge security. And I don't know. I mean, I asked him very briefly. These are very short interviews, so I didn't get a lot of information, but he kind of was trying to convince me that actually their bridge is not that insecure. I don't know if you've looked into it, but
sorry, what bridge?
That the bridge that they use for
the Aztec.
Yeah.
Okay.
Because that was one thing I wondered. But in general, I do feel like privacy is something that will probably come to blockchains in general. And like he was saying, a lot of the people that use it you actually use it to just make payments because like people don't want people to know how much money they're making, which is a very obvious thing, very obvious use case. So I don't know, that was an interesting one. But
yeah, I mean, well, I guess from a pure theoretical standpoint, ZK bridges are usually safer because as long as the proof is not usually dependent on implementation details of the verification. So there's like one side that proves like, hey, these balances are locked, these properties of the contract on mainnet are true. The other side is verifying it. And usually those properties are not dependent on like the precise representation in that virtual machine of how that is done. So that's sort of one of the reasons they're usually more secure. However, no one has built a good ZK bridge yet, so they're one of the first. So, but I would say it's probably more secure, but like also it's the first. So Nil Foundation is probably the second. There's gonna be a bunch of these soon. Alio also. I think from my perspective, I think the cross-chain stuff is interesting. I think Near Protocol stablecoin actually is like probably going to be like the interesting UST competitor. I was like looking at TVLs today and I was like, so there's like 30 billion TVL in Terra, 18 of it is in Anchor, and sort of there's a huge sort of market opportunity to cannibalize some of Terra. And I think like Near actually is like a kind of interesting stablecoin design, which starts super over collateralized. So it's almost like worse than Maker. It's like 2x, but it has this sort of like gradual slowdown into getting as close to 1 as possible under some conditions. And I actually think that that's an interest. It's like different than the Terra model, which starts at like base collateral, like very close to being 1-to-1, which obviously in these algorithmic coins can be bad under crashes. So I think Near's having stablecoins interesting. I think the Justin Sun one's weird because he's
What did you think about that?
He released he just said 30% APY. I went to their GitHub repo. I saw nothing. I saw no white paper. I saw, like I can keep going on.
Wasn't it basically like the structure of USDD? Like a copy of UST, so like basically like backed by TRX, the same way that UST is backed by Luna. It was like, okay, like same mechanism.
But there's no paper on the mechanism. It just said, there's just like these like 5 tweets, like and there's no code in the repo. Which I will say one thing, the Tron developers are actually pretty good. So,
really?
Like surprisingly good. Like they've committed a lot of upstream commits to Geth. They're like one of the few of the people who have a lot of TVL, are basically Geth forks for their client, like AVAX and Tron. Tron's actually committed a lot of PRs to Geth, so comparatively. So, but I don't doubt they'll do something, but I do think it was weird that like they were trying to front run Near because they did it on the same day, and Near's been doing this for a while, like a year. So
you said Near could cannibalize Terra. Do they also have like a lending?
They have a lending. They basically have 2 lending protocols, one that's EVM compatible and one that's native. And the EVM compatible one actually is a pretty, for a like kind of lower TVL overall EVM chain, has like a reasonable amount of liquidity to bootstrap from. So I think the near stablecoin is going to be an interesting competitor. It'll be the first time we actually see like someone trying to go after UST like directly. Maker is obviously going down the real world asset route, so it's like very different growth model than like get more degens. But I think USN will be interesting. The cross-chain stuff between EVM, it's very clear that the EVM compatibility, of course there's multiple layers of EVM compatibility. Are you just compatible with Solidity? Are you compatible with EVM bytecode? Are you compatible with the VM semantics? Are you compatible with byte ordering over the network? You can go down that and get that correct. But let's say we were just at Solidity compatibility. It's very clear that the EVM interpreters running on other chains are beating out the native DeFi protocols. So like Solana TVL, obviously Solana price has gone down, but Solana TVL is significantly less than AVAX, which was very much not true like in November and December. They were flipped. And so you're definitely starting to see a lot more lock-in, minus Anchor, because obviously Anchor is crazy.
Wait, wasn't that you also that said that there's like an EVM on Cardano and then that's actually getting a lot of traction? Was that you?
It's the only thing that has any transactions. No, I think Zeke was saying like all the transactions on Cardano are to the EVM.
Okay, right.
Yes, it's called Andromeda, something like that. So Nomad, which is a bridge, is like, that is one of the chains they bridge to.
Okay.
So are you seeing like a clear kind of like trend where EVM chains will become the leaders?
Yeah, I think the fact that everyone who maybe a year and a half ago was like, oh, we'll never build an EVM like shard or chain, and it has basically had almost all their growth on the EVM shards, so like Aurora on Near, Moonbeam on Polkadot. Like it's just very clear that if you can get an EVM chain and you get like at least one bridge, you will get more TVL overnight and usage than you would if you tried to bootstrap your local. It's just way harder to bootstrap the native stuff because you have no stable coins. USDC is not minting on your thing. Like even for Solana, right? There's you can do native USDC mints there, and the volume of those have gone down quite dramatically. So because of a lot of their DDoS and RPC issues. So like.
Yeah, and you have like all the applications already on Ethereum, then they can just like easily just like deploy on other chains instead of build from scratch.
Exactly.
It's pretty obvious. Yeah.
But the lock-in is in November. If you ask people this, they would have been like, no, like Solana is going to prove that that's not true. And Terra is going to prove that's not true. And Terra to some extent has, although, there's two applications really, Astroport and Anchor, that dominate.
Well, maybe Cosmos, like as an ecosystem, is maybe rivaling like EVM ecosystem.
Yeah, I agree. Let's see once Evmos actually, after its many follies, to say the least, launched today, and we'll see if the EVM assets come over because that's the first EVM chain on Cosmos, so. That's bridged, so they had a lot of DDoS problems on launch. So if we see a lot of EVM assets come over, I think it'll be great. I think the Cosmos ecosystem had this kind of like ICO moment because they had a ton of new assets that all showed up at the same time because of Osmosis, and they basically bootstrapped by just airdropping Osmosis holders. And I thought that was like a very interesting organic growth strategy. I think obviously now it's a little bit tapped out. There's like only so much you can grow that way. But it does remind, they had their own DeFi summer, they had the kind of crash, and now they're kind of like, how do we get new assets on? And that's kind of where they are in my mind.
Yeah. I think we need to open to questions. Like I can keep kind of, I guess like one final question on that topic is like, and going back to Laura's point on bridges, like with EVM chains attracting TVL, like, do you think like the future will be like bridging between all these EVMs so people can just like hop between different like chains, or like is it like one EVM chain needs to win because like bridges aren't secure? Like, what's your view there?
I don't think one will win. I'm not sure if the bridges being secured question will be, I think it's more will they be secure enough for people to feel okay with their assets moving? And I generally have this feeling that there's going to be different bridges for different qualities of service of like, if you are doing low value transactions, but you want to do them quickly, like you're playing a game or you're like funding an item in a game on like, I don't know, an Avalanche subnet or a Cosmos zone, you probably are willing to use like a lower security bridge because it's a small amount of money, relatively speaking. But then there's people, of course, sending tens of millions of dollars, and those will be like the slower bridges, more secure bridges. And I just don't think there's going to be one that rules them all, and it's going to be this like usage dependence determines which bridge you use. Yeah. And they'll be hidden from the user. I think the user just won't even know it anymore at some point. Like the wallet will choose, have some delegation rule, and that's it.
That'd be ideal. What do you think?
Yeah, I think it'll be really similar to financial assets today, where there's just like a lot of different choices, or like technology today. I mean, there's like you can pretty much pick any category, and there's multiple different really good options. And I feel like it's going to be the same. But the thing is that I do wonder if over time we will trend toward a few of them being dominant. But one thing I think in terms of like the EVM compatible chains, I don't know if I would agree with Tarun that, or even it sort of seemed like you were asking this in the way that you posed your question, or assuming this in the way you posed your question, but I don't know if I would assume necessarily that Ethereum virtual machine based chains will always be dominant, because I always just think about how the internet has changed in my lifetime. And, there was a time when everybody used AOL. And now, if somebody emails me using an AOL address, it's a little bit like, what? So, I do wonder, over the long term, will Ethereum really be as dominant? Who knows? But for sure now they are. And for sure, I think a lot of these chains, in order to attract developers in the beginning, they definitely probably, at least, as we've learned in the past few months, I do think it is beneficial for them to have EVMs. So,
okay, I'll finish before opening up to questions with like a New York question, since we're all here. What are kind of your thoughts about kind of building in New York? Like coming from TradFi, like New York is kind of maybe an obvious place to be. With crypto, it's not so obvious, like crypto being more remote, global, but we're still here, like paying really high rent prices and so on. So like, why stay here? Whoever wants to start.
I've been here for 12 years, and I don't know, I've seen like lots of things come and go, I guess, like fad-wise. But the nice thing about New York is like, it's a good place to be if you want your life to be more than like the thing you're working on, I guess. Like you can always just like do all sorts of other things here. And I feel like I've tried doing that in other places, and there's like very few cities. There are some, but like there are very few cities I feel like you don't get either like kind of pigeonholed into like working a lot, or like doing the things that people there do that are not like unique to that place, or like you can't go out all the time, can't be out till 4 a.m. easily.
Yeah, I probably am with Tarun in feeling like the reasons I like to live in New York are not necessarily work related. But what I will say is that I do think that crypto is going to, just kind of encroach on many more industries. And, I've lived in other places in the US, and in a lot of other cities, there's kind of like one dominant industry. Like I lived in LA for a while, and everybody there like works in Hollywood. And then I lived in DC for a while, and everybody there is in politics. And then I lived in the Bay Area for a while, and everybody's in tech. And so like when you're in New York, there's like finance, there's media, there's fashion, there's like all the, top arts, like pretty much, just any industry, like you're going to meet the people at the top of that field. And it's really cool in that regard. And so, if you're thinking about kind of like bringing crypto to these other industries, then you're going to meet like really top players in those other industries. So I would say New York is a good place. But yeah, for me personally, I mean, I've been here like 16 years total, and I keep moving away and then coming back. And for me, it's basically like, I really like walking and public transportation. I really don't like driving. So in the US, it's kind of like the only place really, because I've tried these other cities and they suck basically. So yeah.
Also, everyone eventually comes to New York.
Yes.
You just sit here,
They'll
people
come to you.
always come to you
Yes.
eventually, right?
Yeah,
Like,
yeah.
you can't say that about most places.
Yeah, and the nightlife here is like way better than anywhere else too. Like the parties and just like, you know, in terms of like having fun, like you're not gonna have more fun in any other city, at least in the US. So,
Okay, so favorite place to go out in New York? Speaking of nightlife.
well, I'll tell you this. Wait, no, I don't want people to find me at this place.
I agree.
Because
But I will
person.
say R.I.P. Bossa Nova.
Yeah, there was a crypto person who saw me at my favorite place, and like later they were like, "I saw you there," and I was like, "Oh my god!"
All right. We'll keep that private then. Okay, cool. We'll open up for questions.
Yeah, hi guys. So kind of getting back to stablecoins, it seems like UST will probably die down as soon as that marketing kiddie pool kind of goes away. The 20% isn't sustainable.
Anchor?
Yeah. The Anchor will probably die down. Like Maker's idea of over collateralized lending is like really tough to scale. I'm wondering what you think about like partially collateralized algorithmic stablecoins like Frax and Sperax and I think and Deus, which got hacked today or whatever. But like, what do you think is the stablecoin? Like, what are you looking for in a stablecoin to kind of take the market? Both of you.
I actually think the layer one stablecoins are a little better in some sense for the following reason, which is every algorithmic stablecoin design that's not just like fully over collateralized at all times has some type of bond mechanism. It has to have someone who has like a tranche of the risk that pays out some yield, but then like if there's a bad event, they get haircut and they take the loss. And layer ones naturally have that because they have, or at least proof of stake layer ones, because they naturally have like the staking yield as sort of some form of like a bond like interest earning asset that you can somehow bootstrap your stablecoin from. So right, like if you look at all of the networks that have stablecoins as part of their consensus protocol, it's all proof of stake assets. It's all borrowing against the proof of stake asset that exists. And part of the reason you can do that is that you do have some notion of future expected earnings in that thing already, right? Like you're expecting that, hey, I'm going to earn X%. So in theory, provided that the price of the asset doesn't go too low, I at least have some floor that of like recovery. Yeah. Now, obviously that can go to zero, right? I'm not saying that can't go. I'm just saying that like all of these mechanisms have some bond asset, interest-bearing asset that acts as like a sort of tranche in sort of the sort of corporate debt structure type of sense. And layer ones make it much easier to do it when you do it as part of consensus to have like at least one of those like executing correctly. I think when you do these algorithmic stablecoins on top of another layer one, or not as your own app chain, say in the like Cosmos world, it's a lot harder to guarantee that like certain things get executed correctly right at the time you're failing. Whereas you can at least guarantee your staking reward mechanism works even when the market's under huge duress. And so I'm not saying that means they're foolproof at all. I'm just saying that is a thing that gives them a lot more a belief in that they'll work than say something that's built in an application. Now, that being said, if we look at Frax's strategy is to try to like align themselves with all of the stable coins that are so maybe the consortium model will work, but I do think it's going to be it is kind of just strictly better to be issued by the layer one because you do have just sort of this like one predictable form of yield denominated in the asset, not denominated in dollars. So I'm a little more positive on the layer one ones, but I think in Frax's case they've done a pretty good job of like being the first on every EVM chain, and that was like a very nice sync for them in that you went on Moonbeam, there's no other asset like for like weeks. The only asset was Frax. And then eventually kind of like some people forked Compound and there were different lenders. But it's interesting that like that has been part of their moat is that they've established themselves first on each EVM chain and that's the only asset you have there. So like it's the only thing you can farm with. So I think that they have a really interesting, also disclosure Frax investors. I should say. But yeah, but my point is still like sort of no, I mean Frax equity, so FXS, but I do think the layer ones do have a leg up, which is why a lot of people are either, like in the AVAX case, partnering with Terra, or Frax partnering with Terra, or doing it themselves, like Mirror. And so those are like the two big things that we see. Again, Tron, don't get me wrong, Justin Sun is the greatest farmer in the history of this industry, right? You can just go check the chain. But I just don't know what their thing is. I saw a lot of marketing. I didn't see any like content, serious content.
Thank you.
I don't know. Sorry.
No, I don't have I barely looked into Frax. He's definitely way more knowledgeable about Frax than I am. The only comment really that I have to make is just kind of an echo of what I said earlier, where I really do think that we're just going to have many different varieties. Like there are certain people where they're never going to use some kind of like decentralized algorithmic stablecoin, and it's going to be, like USDC or whatever. And so I just feel like there's going to be like many different varieties, the way that, we go to the grocery right now and there's like many different types of water you can buy. So I just feel like different people are going to have different risk models or, compliance models or whatever it might be. And so they're just going to select based on that. So I don't think there's going to be like, just a few that come to dominate. I really think it's going to be like just a bunch of different ones.
To that point, as running a stablecoin only fund, we have no bank account, but we do have fund manager, but that's a US regulated entity. We can only use USDC. There's like absolutely no way our fund could be denominated in UST.
Interesting. Yep.
I have a question for Tarun. How generalizable is user behavior across protocols? And are there intuitions from behavioral finance and how people interact with traditional finance markets? Do they work with DeFi or do they break down?
Yeah, that's a great question. So yeah, we spent a lot of time doing these hypothesis tests. So one of the things we do when we retrain is like take a basket of different sort of behavioral finance style models or trading models, and then look at which one sort of predicted the observed behavior best and which one predicted the counterfactual, like the thing that didn't happen best, and then we compare them. And one thing that's interesting is that there's way more of this like lottery ticket utility skew type behavior in crypto. So like lottery ticket, people's like expected value that they perceive of a lottery ticket is oftentimes significantly higher than the real expected value, because they like skew their utility on the downside. Oh, it doesn't matter, I only spent $1 on the ticket. But they like overweight their utility on the upside of like, oh, I got like this $10,000 car, and they start thinking, and like there's lots of studies that you see a lot more of that. Although DeFi becoming so much more mature, that's like way less of the kind of, unless you're talking about very, very new protocols on new chains, it definitely is like gotten more rational, let's say, over time.
Oh, interesting. How are you seeing that?
Like basically like when you're measuring these models that you're trying to guess like what people's utility are by like their history, like the chain's all public, right? So unlike normal finance, I can't identify that you did a specific trade in normal finance. I can just try to guess that like you're this type of user and this is probably what your utility was. But here I can see all your actions. So I can try to say like what was the utility like in some sense that you realized on these different set of transactions. And then you try to say like how close was that to sort of like some different type of behavioral model. And you measure these ones that are more rational and like risk averse versus ones that are more like risk seeking, and you sort of like look at like what's the distribution of users that are in those two different categories. And so it's definitely gotten to be more risk averse.
Wow.
Like it started way more like, DeFi summer data, we don't even train on it anymore because like there's just very few people in the market that are like that.
But do you think that's maturity or just like bear market?
No, it's probably
Both.
it's probably more institutional type players getting in, because originally it was just like these DeFi degen type people.
Do you think there's institutions getting in DeFi?
Well, they're definitely
Yeah.
buying into funds.
Like hedge funds, yeah.
I feel like people are offering funds where they're like, I'll put your money in Anchor and take 5%, which is like, that is the weirdest thing. Like, I don't know why anyone would put their money into that, because you could do it yourself. But yeah, it's I think part of it is just more like people have gotten rug pulled a lot. If we're going to be honest, it's just like people have gotten rug pulled a bunch. So now they're starting to be a little less like, oh, I can just, because like DeFi Summer, the reason it worked was you could basically put your money in anything and it was always profitable for this 3-month period because most people didn't understand what was happening, right? Obviously, eventually people will start being like, I can make trap tokens that like you put something in, you can never transfer out. I can do all this other stuff. And then like, once that turned into like the MEV war type of stuff, then there's way more like very deleterious actions happening. People got rug pulled more, etc. And so I think you do in general see this thing of like the risk aversion has definitely gone up, and that we're trying to always like spend a lot of time classifying like current market state based on like that, like what people's sort of risk appetite is. In NFTs, of course, and this is why I don't know how to model them, and like. It's like, I don't know, what is the notion of risk aversion? Everyone in that market is just a supreme kid who's like only there because like they saw some like, someone they thought was cool. Like
someone tweeting something.
Yeah, exactly. It's like, it's very hard to classify that.
Yeah. Yeah.
Kind of another psychology question. So the articles that you produce and the content that you make, in terms of the analytics, does that give you some unique insight into what people are interested in? And are people really interested in the drama, or are they interested in Vitalik's new cocktail, or like, what really resonates with people?
Well, I can take that. So yeah, at the Defiant we have like tons of content going out daily. So yeah, we do get obviously a lot of analytics on what gets the most hits. It's been a little bit kind of disappointing, but also obvious that people are really interested in things that will help them make money. Like, so yeah, like stories on airdrops, like 1,000% yields, like, I don't know, yield farms, NFT, like the big NFT project that sold out, like those types of stories like get the most hits. Yeah, we've started to call them like the free money stories. Like, okay, you have a free money story. Okay, like we have to cover it. You know, like it's what people want. So.
Yeah, and I actually have found interestingly that different platforms are different. Like on YouTube, Bitcoin is huge. There's just like no question. But then like my newsletter, which is just different. I mean, Bitcoin is still actually a big draw, but not the way it used to be, I think, because the people that sign up for my newsletter are definitely like a much different slice than people on YouTube. So I actually think like the different audiences actually react kind of differently. But I would say that surprisingly, like there was a period I remember, it's funny because actually I just texted my assistant yesterday, like, oh, we forgot to do analytics for March, because I have been on the book tour and I just came back like a little over a week ago. So we kind of missed that period. But like there was a period where even just kind of mentioning big companies even could get a lot of opens, but like numbers do really well in headlines, like, just anything that's like a big number, people are like, oh, what's that about? Or, I feel like also second to Bitcoin, Ethereum is also really popular. So it's surprising. It's just like, stuff that's more general. There have been a few times when we've done stories that were like, and kind of more of these niche stories about NFTs that were just like really funny and like said a lot about kind of the craziness of the crypto market. But because they're more obscure or whatever, like people weren't as interested. So, I do think that those ones that have been around for a long time and just have that brand name recognition, they actually get a lot of clicks.
Yeah, you can't fight with like Google algorithm, like keywords are keywords,
Yeah, exactly.
Yeah. Any other questions? No? Okay, well, yeah.
I have a question.
Yes.
Yeah, true. Okay, so I have a larger question about yield farming and protocol risk in general. So, generally, how do you and everyone you work with think about what I call elasticity of yield farming, right? The idea that if you were to reduce the amount of money that a protocol will pay out by like 1%.
So yeah, I think we have a case study of this with sushi, which is most of what we do is actually optimize elasticity.
Right.
So it's like, given sort of there's always this trade-off, right? In at least for AMMs.
All right, I guess a better question: what is the confounding variable that will like affect like that elasticity, right? Because like, of course, like 100% if you want USDC versus USDC and US Terra, or like Tether, like that's like very like considered like a blue chip type of yield. But maybe Ethereum versus Magic on Arbitrum, that might be like more risky to many investors. So that might have different types of trade-offs.
Yeah, so you can like measure a lot of these things, and I think the best way to think about it is like you do this by doing experiments in the same way that you do A/B testing in like a normal statistical sense. You say, okay, like I have some prediction, I go make this change. We then look at and usually the predictions variables are things like LP distribution, history of that user. So like, again, this is the beauty of having a blockchain. It's like, the entire user's history. You can do a lot more about like, well, this person usually is an LP who does JIT LPing and like they're bad. So they're toxic liquidity in the pool. So you filter by things like that. And then you also sort of look at things like how much routing algorithms like Matcha, 1inch, et cetera, change their behavior as a function in aggregate to different pools of liquidity. And from that, you can get a bunch of variables of like, these routing algorithms tend to like respond well to incentives in certain pools, not in other pools.
How do you deal with like asymptotic behavior of large liquidity pools or large market participants?
In the sense of like when it's concentrated, like there's
Well,
one
like
LP.
yeah, suppose a large deployer wants to allocate capital into your pool. Like, what's the solution there? I feel like the answer that you gave just now was more focused on smaller. Capital.
Yeah, I mean the thing is, they're large capital. Sort of people are putting in a lot of money, like a lot, I mean like I don't know, $50, $100 million. They can't be passively liquidity providers in a lot of DeFi. They have to be active in a lot of ways, right? And so, sure, if they're active and rebalancing, but there's probably about like 10 people who are really doing that in both lending pools and liquidity pools. There's very few addresses that are actually like, we have $100 million that we're rebalancing continuously.
Do you mean that there's a few players in 100 million pools that are rebalancing to you, or that there's few players rebalancing at the allocation of 100 million?
The latter, right? That's the reason Uniswap v3 has like no long tail pools. Yeah, right. So like the key is this key balance of like each community has some desired outcome. They want a ton of small LPs. They actually just want like best prices. And once they decide that, then you kind of can decide. The objective function is up to the community.
All right. Okay, this was awesome. Thank you so much for joining this panel. Such interesting conversation. And one final shout out to Colony. So this is the Defiant's Web3 hub in NYC. And everyone is welcome to use this. This is for our community. So, feel free to come, work out of here, have meetings, just come hang out. And yeah, we're here every day. And yeah, again, thank you so much, Laura and Tarun, for this amazing conversation.
Thanks for inviting us.
Thanks, everyone.